So before I jump into my own 2019 market forecast, it's important that I provide you with a little bit of historical context. With the stock market poised to finish this year roughly where it started, actually below where it started, 2018 is a bit like a long-term secular bear market cycle in miniature form. Now, if you're a regular viewer, you've heard me talk about long-term secular cycles before. A long-term secular bear cycle unfolds typically over 15 to 25 years, during which time the market experiences extreme turbulence, including at least 3 major drops and recoveries, only to end up right back where it started 15 to 20 years later. That means zero growth for 15 to 20 years. Now, investors who are not aware of these cycles end up suffering through all that volatility for, zero growth. And when you factor in inflation, when you factor in lost opportunity cost, it's even worse. Now, that refers to the income that investors may have lost by not taking advantage of more stable alternative investment strategies over that time. What I'm defining is the term lost opportunity cost. As far as this secular bear cycle goes, we're now approaching 10 years since the end of the last major drop. That's nearly a record and an important piece of evidence to indicate why the next drop is not only likely, but far overdue. One of the main reasons it's overdue is that, again, we're simply not living in normal times as far as the financial markets are concerned. Historical patterns and trends that have played out in similar ways for over 200 years of market history have all been disrupted by new fiscal policies overly reliant on artificial stimulus. Now, having said that, it's also true that certain patterns and realities have started to emerge in this era of quantitative easing, and these patterns are becoming helpful to forecasters, at least those forecasters who are focusing on the right details. With that, I'd now like to share my own 2019 market forecast, focusing first on interest rates. Now, as we've discussed, the Federal Reserve's stated goal is to approve 3 additional short-term interest rate increases next year. Now, many forecasters are saying it will happen. I say that it won't happen. In fact, I believe there's probably an 80% probability that the Fed will approve only 1 rate hike in 2019. Maybe a 10% probability that it'll approve 2, and maybe a 0% chance that it'll approve 3. Why? Well, as many of you know, when the Fed first began raising short-term interest rates 3 years ago, after holding them near zero for 7 years, I said in an interview on CNBC that the process was going to be much more difficult than others seemed to think. I knew that in order to do it, the Fed would need long-term interest rates to cooperate, that there would have to be enough economic growth, enough inflation for long-term rates to rise ahead of short-term rates. Why? To avoid that thing that we refer to as the dreaded flat yield curve. Of course, I also knew the Fed would be doing its best to manipulate long-term rates upward. How? By trying to artificially manufacture inflation. And also through this so-called reversal of quantitative easing, which involves selling the trillions of dollars in bonds that it purchased during the financial crisis back to investors in the open market. But as I pointed out that day on Closing Bell, if they couldn't manufacture inflation with rates near zero for 7 years, it's going to be really difficult for them to manage it with higher interest rates. And sure enough, they have not been able to manufacture inflation. Although inflation did creep above the Fed's minimum goal of 2% for just a period this year, most data points to it remain stagnant in 2019 and possibly even dropping back below 2% at some time next year. Now, that's just one reason I believe long-term interest rates will continue hitting a glass ceiling, or what we analysts call a strong resistance level, at 3.25% during the entire year of 2019. And why that glass ceiling will essentially handcuff Jerome Powell and the Federal Reserve's efforts to approve additional short-term interest rate hikes. There's also other forces behind this resistance level, too. One is us, the baby boomers, the members of the income generation. We are the largest, most economically important demographic out there. But having been burnt by 2 stock market drops so far since the turn of the century, we have learned our lesson. We're no longer spending and borrowing, pumping money back into the economy that perhaps we shouldn't be. Instead, what are we doing? We're tending to pay down our debts more. We're trying to save more for retirement. Why? Because we have to. And as more and more boomers move away from risky stock market-based strategies and toward conservative options, that will also help keep bond prices up, and that'll help keep long-term interest rates down. At the same time, quantitative easing efforts across Europe and other parts of the world will also keep putting downward pressure on our own long-term interest rates. These factors are real factors that will continue to work against the Federal Reserve's attempts to artificially influence long-term interest rates. And as long as this resistance level holds on the long-term side, then the risk of a flat yield curve will increase every single time the Federal Reserve raises short-term rates, which again is why I'm forecasting no more than one additional rate hike in 2019 and as much as a 10% chance, maybe even more, of 0 rate hikes next year in 2019. Now, as you may know, on December 3rd, the yield curve already became partially flat when the 2-year Treasury was paying more interest than the 5-year Treasury, and it's remained that way since December 3rd. As I've mentioned before on the show, a flat yield curve has actually preceded many of the major market declines throughout history, including the 2 major market declines in this secular bear market cycle starting at the turn of the century. And the flat yield curve is recognized by economists, by and large, as an enormous red flag of a coming recession. Now, with that in mind, the second part of my forecast for 2019 is that economic growth will in fact slow and very possibly, maybe even likely, give way to a recession before the end of 2019. The evidence for this, I believe, is pretty compelling, and even some normally bullish sources are having a hard time ignoring the evidence. A recent JP Morgan survey found that 75% of ultra-high net worth investors actually believe we will have a recession by 2020. 21% of them believe it will start next year in 2019. Now, one reason is that companies, for example, have already ingested all the profits from the Trump administration's corporate tax cuts. Moreover, employment is at near capacity according to most data. Inflation, as mentioned, is expected to remain stagnant or perhaps even in decline. And the slowdown in the housing market, for example, that began mid-year is expected to continue. As you heard Jeff Small mention, we already have a recession starting in the auto industry. Those are just a few of the signs pointing towards stalling growth and a possible recession. Now, there are others, along with a host of unknown factors that can make the economic outlook for 2019 perhaps even a little bit bleaker than I'm portraying here. We'll talk about that more in just a bit, and I will share with you the final piece of my 2019 market forecast that is about the stock market in just a moment. Stay with us. We'll be right back with more here on The Income Generation. As noted, in addition to all the factors that we've discussed, there are a number of geopolitical issues and situations that can make the economic outlook for 2019 perhaps a bit darker than discussed. Those include some of the issues we talked about all year on the show: the trade war, economic instability in Europe, Asia, and elsewhere, the mounting federal deficit, the political turmoil in Washington, which is only likely to increase in 2019 now that the Democrats have the House of the Representatives. Even if none of those situations escalate and lead to a tipping point for the stock market, remember that emotion is the market's main driver, and that fear alone can have real consequences. For example, it could trigger the so-called wealth effect, but in reverse. Even if the stock market only goes down a little, people may start to feel just a little bit less wealthy and therefore perhaps a bit less confident about spending. That helps fuel a recession. And if a little market dip causes people to spend a little less, a major dip could cause them to spend a lot less. Suddenly the recession is huge, prolonged, and it drags the markets down even further. It's basically a matter of the tail wagging the dog until the dog starts wagging the tail again. So, with that in mind, the final piece of my forecast for 2019 is indeed a stock market drop. Possibly the third major stock market drop of this bear market cycle. And if you remember, every single one has had 3 major drops before. Ultimately, this market has to have a 40% drop from where it is today to get below some of the resistance levels on the market, right around 1,500 on the S&P 500. Whether that happens in 2019 or extends in 2020, We'll have to see. But either way, I do believe the stock market overall will end 2019 lower than it goes into 2019 for all the reasons we just discussed, as well as because the market has been overvalued relative to economic growth for years now, thanks largely to artificial influences such as quantitative easing. It really needs to start making fundamental sense again, and I agree with a lot of our guests that the volatility we've seen this year is a sure sign that the process may finally be starting. I also believe you can count on it continuing through 2019. Now, could there be some big spikes in gains over the course of 2019? Of course there can. If the trade war gets settled, if oil prices stabilize, or the Federal Reserve totally takes its foot off the gas on raising interest rates, as I believe it will, then yes, some periods of gains are possible, which day traders can take advantage of. In fact, it's a safe bet there's always going to be some occasional good news throughout the year that gets Wall Street briefly excited and possibly even triggers a new record high or two. It's probably also a safe bet that analysts who are stock market cheerleaders will focus on those factors and on the occasional spikes to support their own forecasts of a booming market for the entire year. But I do believe those spikes will prove to be just more of the extreme volatility we've experienced so far this year in 2018, a continuation of the storm, in other words, and that ultimately the market will finish 2019 with a loss. So what does all that mean for investors over the age of 50, members of the income generation like us? We'll talk more about that in my summary coming right up. Stay with us. We'll be right back here on the Income Generation. I'd like to thank all 10 of our guests for joining us for another episode of the Income Generation. Of course, I'd like to thank you, our new and returning viewers. So let's recap. Of our 10 guests, the consensus seems to be half of them believe a recession in 2019, but all but one believes that we'll end the year lower in 2019 in the stock market, with a majority being in that 15 to 20% range and another group being 25 to 30%. And one bull saying, Eddie Gabor from Delaware, saying we're going to end up by 12%. To summarize my forecast, I anticipate the Fed will be able to approve no more than one short-term interest rate hike, possibly none next year. Why? Because long-term interest rates are going to continue to hit a strong resistance level at 3.25%, threatening a fully flat or inverted yield curve. Next, economic recession, yes, is likely in 2019, or at least a significant slowdown in the growth we've seen this year. Third, I believe the stock market loss is likely from the start of 2019 to the end. Yes, there could be some spikes in between that day traders could take advantage of, maybe even getting near the previous peak of 27,000 on the Dow. But in the end, it'll prove just to be one more set of extreme volatility points that we've experienced all year. A continuation of the storm, in other words. With all this in mind, it's up to you to decide whether you want to continue riding the storm out for another year or whether it's time to take shelter. While no investment strategy is 100% safe, if you're a regular viewer, you know I believe the safest, smartest option for many investors today from the income generation is investing for income. Those income-based strategies are designed to protect your investment principal and generate reliable income to meet your retirement goals regardless of stock market conditions. And that includes the kind of extreme market volatility we've experienced through 2018 and are likely to experience again next year. Keep in mind, those who successfully rode the Wall Street storm out this year are likely to end up just breaking even if they're lucky. And if the stock market does indeed finish at a loss next year, as I'm forecasting, they won't ever be that lucky. Keep in mind that in this unprecedented age of economic uncertainty, the reality for 2019 could be much worse than I or anyone else are forecasting. And most importantly, keep in mind that continuing to ride the storm out isn't necessary. There is an alternative, a way to protect your money, to grow your portfolio strategically, and create a reliable income stream to achieve your retirement goals without having to worry about market turbulence. Make it a resolution to learn more about it in 2019. Happy New Year, and thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential you stay informed and up to date, and right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again. We'll see you next week.